Federal Reserve officials are now forecasting just one single interest rate cut for 2024, reinforcing their message to tackle inflation by keeping borrowing costs higher. This is a big decrease compared to just a few months ago in March, where the expectation was for there to be 3 rate cuts across the remainder of 2024. And this comes after Fed officials have repeatedly said that interest rates are likely to stay elevated for longer after price pressures picked up in the first quarter. And this includes Patrick Harkett, Federal Reserve Bank of Philadelphia president, who says one rate cut in 2024 is appropriate based on the current inflation outlook. New inflation data coming in shows that we are still a long way off fully tackling inflation, as the latest CPI reading of 3.3% marks the 38th consecutive month of inflation being above 3%, despite the latest reading actually being below expectations. The Fed also raised their underlying inflation forecast for 2024 to 2.8%, up from March's 2.6% forecast a few months ago. And Harker added that he wants to see more economic data to be confident inflation is heading back to the central bank's 2% goal, and that he sees a long glide back to the Fed's inflation goal. In other words, he is saying that it's going to be a long time before we get back to acceptable levels of inflation. The Fed has also increased their estimate on where interest rates will settle in the longer term, which does suggest that many officials expect borrowing costs won't return to their pre-pandemic levels. Now, keeping interest rates higher for longer seems to be a necessary step the Fed needs to take in order to tackle this stubborn inflation that is yet to be defeated. However, this will be catastrophic for many other areas of the economy, which is the big problem that they are now facing head-on. This includes the banking industry, which is seeing eye-watering unrealised losses from devalued loans and is facing a potential second wave of banks collapsing before rates are cut. And it also includes real estate that is suffering from rock-bottom affordability and record-low mortgage applications due to how high mortgage rates are, and the average home buyer is now spending a higher portion of their income on housing costs than at any point since the 1980s, which can be seen on this chart showing the housing payment-to-income ratio. Housing is even more expensive than the peak seen during the global financial crisis, and the entire real estate industry really does feel like it's just on standby right now, desperately waiting for rates to come down. And of course, this is also bad for all of the consumers who have auto loans, student loans, or credit card debt, who are currently paying record high interest rates on this debt, which is squeezing many households to the absolute limit. And rates remaining high for longer is also bad for the labour market, and there were a number of warning signs in the latest jobs report that came in the other week. On the surface, things looked quite strong, with the US adding 272,000 more jobs from the previous month, beating expectations from most economists. But digging deeper, we can see that things are not as they might seem, and there are in fact a number of cracks emerging. Now, first of all, the majority of these 272,000 jobs came from 3 main categories: health and education, leisure and hospitality, as well as government. And in fact, 617,000 new government jobs have been created in the last year alone, which makes up a whopping 22.4% of all new jobs over the last year. This begs the question, where would the jobs market actually be without the government making up a significant portion of these new jobs that have been created in the last 12 months? This latest jobs report also shows that the unemployment rate has unexpectedly risen to 4%, coming up higher than expectations, and does end its 27-month streak of being below 4%, which was the longest such period since the 1960s. Meanwhile, the household survey showed that the number of people in employment declined by 408,000. Aside from this top-line data though, from hearing things online of people who are actively searching for a job right now, the general message is that things are quite tough right now. Indeed's job posting index shows that things have been on a consistent decline since January of 2022, where things peaked. And certain big sectors like finance and tech have been hit extremely hard, and looking at the Indeed indexes for these specific sectors, we can see that the decline in jobs has been so severe that we are actually now below the pre-pandemic levels. And this recent increase in the unemployment rate is likely to only be the start of a steeper and more sustained rise in unemployment that could take place over the next few years. Now this is because economic data across all of history does show us that the unemployment rate follows baseline interest rates, but lags behind by a few years. Now this correlation of interest rates going up and then the unemployment rising a few years later can be observed at pretty much all time in history, and there is no reason to suggest that this time is any different. Interest rates have just rapidly increased from basically zero to now being between 5.25 and 5.5% over the space of about a year and a half, and the rate hikes started in March 2022, so a little over 2 years ago. Therefore, based on this observed correlation over history, the unemployment rate is due to start rising to follow interest rates anytime soon, and this rise seems to have already begun. And it goes without saying that rising unemployment is something that can be observed throughout every recessionary period in history. Something else that correlates strongly with historic recessionary periods is falling interest rates, and although we've just been talking about the updated Fed forecasts that show that rates are going to be staying higher for longer, they are also now suggesting that they will fall sharply in 2025. This is because despite there being just a single rate cut being forecast for 2024, the number of rate cuts being forecast in 2025 has increased from 3 to 4. And this is yet another economic signal suggesting that over the next 12 months or so, we are going to see the unemployment rate rise and a recession kick in, resulting in the Fed consequently cutting interest rates in response. The fact that many banks are struggling to keep their head above water at these current rates too will pile even more pressure on the Fed, making it seem inevitable that they will have no choice but to cut rates in 2025. And on top of that, we've also got recent news that the US deficit has grown a further 5% from a year ago, fueled by high borrowing costs, and now takes the year-to-date deficit to $1.2 trillion. And with US government debt skyrocketing and their annual interest payments on this debt surging to insane highs, now over $1 trillion a year, it is going to be in the government's best interest as well for interest rates to fall. Ultimately, the Fed is stuck between a rock and a hard place with their upcoming decisions on interest rates, and no matter what they do, certain parties will suffer. For every extra month that rates are kept at these current high levels, it inflicts more pain to various sectors of the economy that I discussed earlier. However, cut rates too quickly and inflation will start to rise again, meaning that we would be facing the very scary prospect of an era of stagflation. Now, as mentioned, the banking sector looks to be the main area of risk as a consequence of these higher for longer rates, and combined with the ticking time bomb of commercial real estate and the looming maturity wall that comes with that, it is putting many banks at risk of failure in the coming months and years. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please be sure to leave a like and subscribe if you enjoyed the video, that does help out a lot, and thanks a lot for watching.